Hello everyone, this is Margaret Yang from CMC Markets. First of all, I need to apologize for those who stayed back from my webinar last night. There seems to be some technical issue with the webinar and there's no audio being recorded. So therefore today I am redoing this webinar again. Hopefully that you can learn something from this webinar on the impact of COVID-19 on global markets from equities, commodities, and forex perspective. All right, so before we start, let's do a quick disclaimer. So whatever information shared in my webinar today is solely for information and education purpose only. CMC Markets is positioned as an execution-only provider, and we don't give any buy-sell recommendations or financial advisories. All right. So, introduction of myself. I'm Margaret Yang. I joined CMC in 2016. So I've been with the company for more than 4 years. And if you do watch some financial media like Channel News Asia, BBC, Bloomberg, or even CNN, you may see me sometimes on the TV to comment on financial markets. And also, if you do drive, you may also hear my voice on Money FM radio, CNA 938, and also Capital 958. Those radio channels. I have regular slots with them. And do follow my Twitter here at Margaret YJY. And also we have a WeChat account by CMC Markets, and I do post some Chinese commentaries on WeChat every week. So do copy this slide and add me later. All right, so let's move into today's topic. First of all, let's have a recap of the major themes in 2020. So before this COVID-19 hits global market, actually we are expecting a cyclical recovery in global output and demand, especially after the signing of a phase 1 trade deal between US and China in January this year. So later on, I'm going to show you some macroeconomic data is suggesting that global demand is actually picking up. Manufacturing sector are turning upwards from their PMI readings, and by right, some cyclical sectors like technology, semiconductors, industrial, finance, and consumer discretionary are actually going to gain favor again before this COVID-19. All right, so the phase 1 trade deal was signed in January, and a phase 2 deal will be postponed until the election in November. And in between, China has committed to purchase a lot of US goods, not only the agricultural goods, but also the manufacturing goods from the US. And China has also committed to respect the intellectual properties and technology, patents. And also, China has issued multiple financial licenses for US companies, a lot of which will start from April this year. All right. Then a big event this year will be the US election, which is scheduled in November this year. And from what we can see right now, Donald Trump has a high chance to win this election and be re-elected in November, because from Democrats, there's no promising candidate that is strong enough to compete with Trump at this moment. And even though that many people don't like Trump, but he is a market-friendly president. Since he took office, U.S. equity market has rallied more than 35%. All right, he's very market-friendly, and looking forward, I think he will address foreign policies and perhaps negotiate a better deal with the European Union and many other countries in the world to benefit U.S. companies and benefit U.S. Employment market. And also, he's perhaps going to announce an infrastructure plan which is worth of billions of US dollars. All right. And last, let's come to our topic today, which is COVID-19, which is totally unexpected. The COVID-19 outbreak started in end of January from 20th of January, right before the Chinese New Year. And even though that now is only 3 weeks from the outbreak, the market has totally become so turbulent and overreacted on this issue. It is likely to have significant economic impact to the Greater China and Asia Pacific market, especially in the first quarter or even second quarter of this year. But we would expect a temporary distortion in consumers' behavior and the manufacturing sector business activities. The impact is likely to be short term, and we do expect a recovery and rebound in the second half of this year. And in light of COVID-19 headwind, I do believe that central banks around the world will be more accommodative to carry out monetary and fiscal stimulus, especially in those countries that are badly hurt by COVID-19. So here I summarize this table to show you how big the impact is in terms of the GDP growth. So here are the countries that are getting affected and the previous GDP forecast versus the revised forecast after this COVID-19. So first of all, mainland China. All right, right now 98% of the infection cases are in mainland China. Only 2% are in the rest of the world. So the big impact to China. GDP growth is likely to be revised down by 1 percentage point for the whole year of 2020. And in the first quarter, we may even see a 2% revision down in the GDP growth. All right. So this is China. Then Singapore. MTI on this Monday has revised down Singapore's 4-year growth forecast by 1 percentage point from 0.5 to 2.5% to negative 0.5% to 1.5%. All right, this is because Singapore is an open economy and tourism contributes to more than 4% of the country's GDP. And for this year, the tourism board expects a drop of 30% visitors to Singapore, which is likely to have a big impact to the overall economy. All right. Then Japan. We need to take note that Japan is hosting Summer Olympic in July this year, and Japan is now the country that has the largest number of infections outside of China, and the number is still increasing. So even though Japanese government says they won't postpone or cancel the Summer Olympic Games, but the number of attendees to this Olympic may still drop significantly if the situation continue to roll out in Japan. So I would expect a 0.3% drop in Japan's GDP growth for the full year of 2020 from 0.8% to 0.5%. All right, Australia, the central bank's forecast full year growth to be at 2.7%, but I think this is too optimistic. Some analysts and economists, they have revised down by 0.5% to 2.2% because Australia is very closely related to China in terms of commodities export and their business activities. So a slowdown in China is definitely going to have some impact on Australia as well as New Zealand. And last but not least, Thailand. Interestingly, that Thailand has revised down its GDP forecast by more than 1% because the country is highly reliant on tourism arrivals. And we have seen that Thai baht has depreciated quite a little bit against the US dollar since the outbreak. Okay, then let's take a closer look at the COVID-19 infections around the world. A breakdown of the total infections, accumulated cases, the current cases, the death toll, the number of patients being cured, and very important is the mortality rate. How severe is this disease to the human being, right? So around the world, right now we have a total 75,000 infections, accumulated infections around the world. And some 98% of them come from China alone, right? 74,000 cases come from China, and the rest of the world accounts to only accounts for only 2% of the total infections. And most of the death numbers we saw also come from mainland China. And in China, Hubei province, which is the epicenter of the outbreak, contributes to 87% of the total infections, whereas the rest of the China only 13% ex-Hubei. And when we talk about the city of Wuhan, Wuhan is actually the capital city of Hubei province. All right. Then the mortality rate in China is 2.7%. However, if we look at a breakdown into Hubei province and ex-Hubei, it's pretty different. We see a totally different picture. So within Hubei, the mortality rate is 3.1%, pretty high, whereas outside of Hubei province, it's only 0.7%, much lower than the mortality rate seen in the SARS period, which was more than 10%. Okay, I think why we see such a different result in terms of mortality rate is because Hubei province is lack of resources to cure those patients. A lot of patients, they can't even go into the hospital and get a bed. They can't get prompt assistance with their disease. Not enough of doctors, not enough of facilities. So that's why the mortality rate is much higher than the country average. And if we look at global ex-China, the mortality rate is even lower at 0.33% only. All right, so that's a more so when we look at a number, we should not just look at a total number and total mortality rate. We need to be more objective on this issue. All right, the high mortality rate in Hubei province is not because of the virus itself, but more because of lacking of resources. Okay, then the way that I look at COVID-19 spread is to look at daily increase of infection cases. Even though that a lot of media, they like to highlight, wow, there are more than 1,000 cases increased per day. But if we look at a trend, actually the number of cases increased per day has peaked on 4th of February. All right. And since then, it has started to trend lower within Hubei province. So this is within Hubei province. So interestingly, that financial market has actually started to react after 4th of February. Later on, I will show you some charts, very interesting, like crude oil and copper and many shares. They have actually started to rebound after 4th of February. Okay, this is when the number of new cases peaked and started to decline. So this chart is from 20th of January all the way to 11th February. What happened on the 12th of February? We saw a spike up in the new cases, and this is not because a lot of patients are diagnosed, but because China has changed the counting methodology by including clinical diagnosed cases. So this is like a one-off increase in the total numbers. And after that, the numbers started to drop again. And perhaps more important is to look at the new cases outside of Hubei and in China, which is giving us a very encouraging trend. The number of new cases confirmed outside of Hubei province has been declining for more than 15 days. All right. And the total number has decreased to less than 100 in the last couple of days, which is very encouraging because Hubei province contributes to only 5% of China's overall GDP, whereas 95% come from the rest of China. And right now, many factories in Zhejiang province and Guangdong province, which are the driving growth engine of China, they have resumed operation. So more than 70% of the factories have started working in those places. All right, and here is how market has reacted against the COVID-19. So apparently, healthcare and defensive sectors and technology were on demand. So I use some examples here. In Singapore, it's Parkway Life REIT, which is a hospital REIT, which that has been doing pretty well over the last couple of days. All right, it's trending higher. But I think it's not wise to chase up high on healthcare sectors because they have priced in too much of growth. And when this COVID-19 disease start to be contained, which is happening now, I think the upside is limited for this kind of shares. And if we refer back to SARS in 2003, actually healthcare sector underperformed the benchmark index in the 12 months following the SARS. Okay, and interestingly, technology sectors are benefiting. Here I use example of Google. It has been doing pretty well despite of COVID-19 outbreak. And other shares that has been performing well includes Alibaba, which is an e-commerce giant in China, as more people are shifting to online shopping when they cannot go out to purchase goods. And another share is Tencent, which is a technology company that owns WeChat, which has been very powerful nowadays, and also gaming. It is a gaming giant as well. As more people have to be stay at home, they actually subscribe for more digital services and play more mobile games. So Tencent's earnings likely to be boosted in the first quarter. So those sectors getting hammered, including transportation, aviation, tourism, retail, banks, and consumer discretionary. So example here is Singapore Airline, okay, which has been trending lower as the number of tourism arrival to Singapore is likely to drop by as much as 30% this year. And many trips has been cancelled, many flights have been cancelled because of COVID-19 and traffic bans. Another example is Genting Singapore. Okay, right. The share price has collapsed more than 10% before it rebounded. So interestingly, if you look at the rebound, it actually happens on the 4th of February here. Okay, 4th of February. This is when the number of new cases in China started to decrease. All right, so market is very smart. What we can learn from here is that market is always forward looking. It doesn't price in what is happening now, but it try to forecast what's going to happen in the future. Okay, in impact to currencies, obviously that emerging market currencies has been underperforming the safe haven currencies like Japanese yen and US dollar. So in the past 2 weeks, we saw that Australian dollar and Kiwi dollar were trending lower to a multi-year low, I think. And Aussie dollar this morning has broken down below 67 cents against the US dollar. This is partly because of commodity prices continue to drop, and also because of the close economic tie between Australia and New Zealand to China. All right. So these two currencies are very closely linked to China's economic growth. Another thing is Singapore dollar. So Singapore dollar was the safe haven currency in Asia Pacific region, especially in Southeast Asia. However, Sing dollar has dropped more than 3% against the US dollar since the outbreak of COVID-19. And this is because of two reasons. First of all, the Monetary Authority of Singapore has said a week ago that it has plenty of room to ease the currency in order to cushion the COVID-19 impact. Another thing is the Singapore budget. So this year we have the widest budget deficit since 1997, and the government has set aside a big chunk of money to support the SMEs and private sector to overcome the difficulties in the first half of the year. All right, so a bigger physical deficit, a dovish monetary stance is sending Singapore dollar much lower. All right, and it perhaps has more room to go down. But a weakened currency is positive to the stock market, and it's positive to the economic recovery as the manufacturing and export sector is likely to get boosted by a weaker currency. All right. Then a dollar has been the biggest winner nowadays. This morning, dollar index has reached 99.5. I think it is heading towards the 100 point level. Dollar index has been outperforming other currencies because of its safe haven nature, and also because that U.S. economy is relatively more resilient against the COVID-19 comparing to the rest of the world. All right, impact to commodities. So we have seen a very different picture for precious metals versus the industrial commodities and energy commodities like crude oil and copper. So gold price has been doing pretty well because safe haven is on demand in a time of uncertainties, and gold price has jumped up to $1,630, I think, this morning, a new high. And this, I would like to highlight, this is a precious metal index that is created by CMC Markets. In this index includes gold, palladium, and silver. So 4 types of precious metals in a index. So when trading index, you have a better diversification. You don't have to worry about should I buy gold or silver or precious or palladium. All right, this is precious metal index. And then crude oil. Crude oil was trending down. All right, and only recently that its price has rebounded, and there are some positive signal here. Crude oil has actually broken out above this resistance level, and its super trend has flipped to the upside yesterday. Therefore, I think crude oil is now facing a recovery, and the price may go up even more higher from here. So crude oil price is actually trading in tandem with China conditions, as China is a big importer of energy commodities, and as the factories in China started to operate again in the last couple of days, oil price is rebounding as well. Then copper. All right, copper price also bottomed out on 4th of February and is now recovering. Manufacturing PMI readings. All right, so this is the figure before COVID-19 kicked off in January. So we saw that in China, Singapore, and European Union, as well as the United States, there seems to be a recovery in manufacturing sentiments. So China, the PMI in January has reached 50.0. So coming to the threshold between expansion and contraction. So 50 is the watermark of between contraction and expansion. Recovery here. Then Singapore, the manufacturing PMI also is going higher into 50.3 in an expansionary territory. For European Union, it seems to have bottomed out as well. And US, well, the manufacturing sentiment is pretty good. Okay, 50.9. It is one of the strongest comparing to global peers. Then let's take a look at exports. Exports are also pointing to a recovery in beginning of the year. So China's export in January advanced 7.6%, which is much higher than expectation. All right, Singapore also is only down 3.3%, which is better than expectation. Expectation is highlighted here in a white bar. And for Japan, the latest reading was also better than expectation. We saw that this contraction in export growth has been narrowed down in the last couple of months. And for the United States, the trend is also pretty good. The trade deficit has been narrowed down significantly in the second half of the year, even though that it is still trading in a deep deficit with the rest of the world. Okay, and I would like to share with you a comparison of MSCI World Index versus MSCI Emerging Market Index over the horizon of last 2 years. And I have marked the major market events throughout these 2 years. So the trade war kicked off in May of 2018, and since then, emerging market index has largely underperformed the developed market, especially US. And in the second half of 18, US market collapsed more than 20%. And then the Federal Reserve came out and say, ho ho, we are not going to raise interest rate anymore. We're going to cut interest rates. And this, I would call it a Fed turn. Okay, Fed turns dovish. And there were 3 rate cuts in the end of 2019, and US market has recovered. We had a pretty decent year in 2019. And then a trade deal between US and China was announced in November, which fueled a rally of US index to a record high, and phase 1 deal was eventually signed in early January. But just a week after the signing of the trade deal, COVID-19 happened, and we saw a quick sell-off in emerging markets. So based on these two lines, it's pretty clear that emerging markets represented by China and Hong Kong and India, all these and even Singapore, they suffered a much bigger sell-off comparing to the US market. All right, US market is pretty resilient and didn't move much because of COVID-19, and it's quickly rebounded here and reached a new high. Whereas emerging market, they are still halfway through the recovery. Okay, here. And this makes sense because COVID-19 is having much bigger impact to the Greater China and Southeast Asia comparing to the rest of the world. But I think in the mid to long term, this gap between the MSCI World Index versus the emerging market is going to narrow down. All right, that means a US market has been overbought, whereas an emerging market has been oversold, and this gap needs to be closed in a mid to long term. Evaluation comparison, I have selected some key market and key market index and constructed this table using their price to earning ratio, price to book ratio, and their trailing 12 months dividend yield. And right now, Straits Times Index is trading at about 12 times PE, Hang Seng Index at 10.8 times PE, Hang Seng China Enterprise Index at 8.5 times PE only. So these 3 indices are among the cheapest globally, all right, in terms of their price to earning ratio. And let's take a look at Shanghai Composite 14 times. US S&P 500 is trading at 22 times PE. This is pretty high, even comparing to its historical means. All right, historically, S&P has been trading at about 15 to 16 times, and right now it's 22 times. It's looking a bit expensive now. All right, then let's zoom in into Hang Seng Index. This is a 7-year horizon, 7-year Hang Seng. This black line is the Hang Seng Index, whereas the red line here is its price to earning ratio. Okay, so I have highlighted a few horizontal line here, which is the average PE of Hang Seng Index. 7-year average is 11.3, and right now we are trading at 10.8, which is slightly below the 7-year mean. And this yellow line is 1 standard deviation above its 7-year mean, 12.5 times PE, and this is 2 standard deviation above its 7-year mean at 13.7. So the higher the PE ratio is, the more expensive the market is. So if Hang Seng is trading at above 13.7 around here. It means that market has been severely overbought and getting very expensive. And this is the time when the market is due for a correction, like what happened here in 2018. So on the other hand, this green line is one standard deviation below the 7-year mean, which is at 10, which means this level shows that the market is relatively attractive and relatively cheap. And if the PE ratio come down to 8.8 times, which is 2 standard deviation below the 7-year mean, it suggests that the market is very cheap now. Okay, it's coming to a very attractive level, like what happened in 2016. All right, and market rebounded very sharply here. Okay, so this is how we look at the relative as the price to earning ratio, the valuation of Hang Seng Index from a historical perspective. So right now, 10.8 times seems like not expensive, but not too cheap as well. I would say that when Hang Seng Index come down to 10.0, then it looks like a better opportunity to accumulate in a short to mid term. Okay. Then the same method applies to Singapore's Straits Time Index. So right now we are trading at 11.9, about 12 times. 7-year mean is 12.7 times. So we are trading slightly below the 7-year mean and above the 1 standard deviation below the 7-year mean. So the rule of thumb is when the STI is trading above 13.9, 1 standard deviation above, it's getting relatively expensive. And when the PE is trading above 15.1 times, it is getting very, very expensive and is due for a correction, like what happened here. The opposite applies to the reverse. So if PE drops below 10.4 times, it suggests that market is very cheap, like what's seen here in 2018, and the market should recover quickly from here. Last, take a look at S&P 500 index. So we see a very different picture in the US market. All right, S&P has rallied. Wow, that's more than 100% in the last 7 years, right? From 1400 all the way to now 3300. So the price to earning ratio has been trending higher as well, showing in this red line. So it is now trading at 22.3 times PE, which is getting very close to 2 standard deviation above the 7-year mean. All right, that's 22.8 times. So US market seems to be pretty expensive in terms of its PE ratio, and I guess Donald Trump will need to do a lot of work in order to sustain the market above this level. And what he can do is perhaps to launch a physical stimulus, trillions of dollars of infrastructure plan. And another thing is he can perhaps negotiate a better deal with trade deal with European Union to get more jobs for US employees. Okay. All right. Next, let's take a look at the real market. Okay. Let's do a quick analysis, technical analysis on the major indices. So here is Hang Seng Index, a day chart. So here I would like to highlight to you a very important pattern, which is called a Getlots 222 pattern. All right. So Getlots 222 pattern. Let me show you an example here. So this is called Getlots 222 pattern. A bullish pattern is formed by an OA lag, a bullish OA lag or XA lag, followed by a ABCD pattern. So this ABCD pattern serves as a correction of this OA lag. And after this correction, the market will pick up its bullish direction and go up higher. So that's why we call it a bullish Getlots pattern. All right. And what is an ABCD pattern? ABCD pattern has two legs. One is AB, another is CD. So the time to form this AB lag should be similar to the time to form this CD lag. And the length of this AB lag should be similar or identical to the length of the CD lag. So once you identify this pattern, you can find a D point and set a buy order here with a stop loss just below the D point. Okay, so this is the entry point to buy and wait for the market to recover here. All right, so this is a typical bullish Getlots pattern. The reverse is true for the bearish Getlots pattern. So we need to identify a bearish long OA lag followed by an ABCD pattern. So this ABCD is a technical rebound of this OA lag. A rebound. After this, it will continue its bearish trajectory downwards. So that's why we call it a bearish Getlots pattern. So once you identify this ABCD pattern formed, you can put in a sell order somewhere here with a stop loss just above the D point in case that the pattern didn't form. All right, so stop loss somewhere here and then wait for the market to go down with a short sell order. Okay, now let's come back to this real example. So apparently in Hang Seng Index, we can see this OA lag formed, and then followed by an AB and CD lag, and the market rebounded from here. So this is the D point. We can set a buy order to buy somewhere here and put a stop loss right below the D point and wait for market to go up. So the pattern is pretty good. Market recovered here strongly and before the COVID-19 kicked in 1st January. All right. So how to draw this Getlots pattern? Let me show you. Okay, you just need to go to Draw Tools. And you see here, this is Getlots butterfly. So this function combines both the Getlots pattern with the butterfly pattern. All right, so just click on it. Identify your OA lag. Then find your A, B, C, D pattern. All right, so just click on 1, 2, 3, 4, 5 points, and this Getlots pattern will appear here. Okay, so let me show you one more time, just in case that you didn't catch it. So in the Draw Tools, find Getlots butterfly, click on it, find your OA lag, which is a bullish lag, then A, B, C, D. This is ABCD, a correction of the OA lag. After this correction, the market pick up and go up again. Okay, and not only this Getlots pattern, we are also putting a super trend 10 and 2 into the Hang Seng chart. So let me draw it. Super trend can be found in technicals, and you can scroll all the way back, find super trend. Just click on it. Okay, and because Hang Seng has been pretty volatile these days, I adjust the parameter to 10 and 2, and I want it to be more obvious, so I changed the line width. Okay, Hang Seng is here. So the Getlots pattern is giving me one buy signal. After that, another buy signal was formed here when the super trend turns from bearish to bullish. So this very strong candle is a bullish signal as well. All right, I have two buy signals, and here, all right, the super trend gives me a sell signal. But of course, Super trend is a lagging indicator. It only flips when the market started to trend down. So we need to use other indicators to combine with super trend in order to better time the market. Okay, so now it's this is a sell signal, and another buy signal appeared somewhere here, but of course it's again a lagging indicator. If you want to be more accurate, we can use momentum indicator in the technicals and studies. All right, so momentum indicator, usually I'll use DMI, MACD, and RSI. Okay, these three. But for Hang Seng, I perhaps focus on the DMI and MACD first. So TMI here is giving me a strong buy signal somewhere here. Okay, when this red long bearish bar forms, a DMI is giving me a buy signal. Why is that so? Okay, because you see the width of the DMI has maximized and started to trend down, to narrow down somewhere here. So this is a buy signal because it suggests that the bearish momentum has peaked and started to decline, and that's where the buyers coming back to the market. Okay, so DMI is giving a buy signal here. I like to use DMI because it's one of the leading indicators, very effective. So another buy signal was appearing here. Okay, the MACD. The MACD has formed a bullish crossover here, and the MACD has formed a bearish crossover. Oops. Okay, here is a bearish crossover, and if you like to highlight it, it is giving you a strong selling signal somewhere here. So just a day before super trend changes the direction, its MACD is also giving you a sell signal. All right, so if we follow all these indicators, super trend and MACD and DMI, you can actually capture a lot of selling signals and buying signals somewhere here. All right, so on top of the patterns. So right now, what we are seeing here in Hang Seng is that it's ranging because the DMI is not giving very strong signals. It is ranging, and MACD also has been pretty narrow. So momentum-wise, it has slowed down. The market is perhaps not decisive of where to go next. Beside of this, I would like to share with you another useful tool called Fibonacci retracement. Okay, so since the outbreak of COVID-19, we have seen market sell-off very quickly. All right, this bearish trend, and then there's a reversal of this bearish trend from here. So this time we can draw a Fibonacci retracement. How to do it? Draw tools. You go to this Fibonacci retracement. You pick the recent high and pick the trend low. Okay, just connect these 2 points and the retracement will come back. It tells you where the market is going to. And I highlighted somewhere here, which is a 61.8% Fibonacci retracement level. It is a very promising level because mathematically this is a golden ratio. It is where most of the retracement will come to hit, and before it faces some resistance. All right, so magically 61.8%, which is pointing to about 27,900 points. Strong resistance, some selling pressure came in here. So where the market is heading to, I guess it's going to have some support around here. Okay, the support level is here, 38.2%, 27,150 points is the support level. Okay, so these few days market is a bit indecisive. The volume has slowed down a little bit. Then let's take a look at the US market. It's very bullish. Here I use super trend 10 and 3. All right, and yes, so the market is in a very bullish uptrend. Look at how super trend has given you these signals. Okay, a buy signal here, a sell signal here, then a buy signal here, and the market ran up all the way until 24th of January. Okay, this is COVID-19 impact, and very quickly market bounced back, and super trend is now in a bullish setup again. But I think some resistance may be found in 3,400 points, which is perhaps a psychological level, as a psychological resistance level. And here I use Fibonacci extension upwards because market is forming higher high and higher lows. And it suggests that 200% level got strong resistance. Okay, but this resistance has been broken out. But I guess the next one will be 3,400 points. So how to draw Fibonacci extension? Go to draw tools. You can find it here, Fibonacci price extension. Okay, click on it. Okay, you have a low, you have a high, you have a second low. Okay, that's a better way of doing it. So a low, a high, and a second low, which is higher than the first low. Then you can do an upward projection. Another example of Fibonacci extension is perhaps this crude oil. Okay, now I want to draw a downward Fibonacci extension. Okay, you have a first high, you have a low, you have a second high, which is lower than the first high. Okay, so we have this downward projection. In downward, 100% is the first support level. Another significant level would be 161.8%, which was proven to be a good support for oil price here. And on top of Fibonacci extension, I have used super trend 10 and 2 in order to find a good trend for oil. So yesterday, super trend is giving me a buy signal here as crude oil has broken out above the super trend and its direction has flipped into bullish setup. So where is market going to go now? Let's draw a Fibonacci retracement. All right, and we can find 61.8% level. I think oil got a good chance to rebound and head towards this level, 64.6 for Brent. All right, so from the technical analysis, you realize that a lot of things we can do within the platform with super trend, with Getlots pattern and Fibonacci drawings, momentum indicator like DMI, MACD, and RSI. If we can learn how to do them and keep practicing, I think you will become a very good technical trader. All right, so that's about all for my webinar today, and I hope that you have learned something from my sharing. And thank you so much for watching this.